The bleak data highlights the challenge for Chinese policymakers as they proceed with pandemic prevention measures and seek to address broad pressures from rising inflation, sweeping hikes in global interest rates, and a global slowdown. Outbound shipments fell 0.3% in October from a year earlier, a significant reversal from a 5.7% rise in September, official data showed on Monday, and far below analysts' expectations for a 4.3%. It was the worst performance since May 2020. Chinese exporters have not even been able to capitalize on a sustained weakening of the yuan since April and the key year-end shopping season, underscoring the mounting strains on consumers and businesses worldwide. The yuan slipped from a more than a week high against the dollar on Monday, said in the previous session, as weak trade data and Beijing's promise to continue its strict zero-COVID strategy weighed on sentiment. The weak export growth likely reflects both poor external demand as well as the supply disruptions due to COVID outbreaks, said Jiwei Zhang, chief economist at Pinpoint Asset Management, citing COVID disruptions at a Foxconn factory, a major Apple supplier, as an example. Apple Inc. said it expects lower than anticipated shipments of high-end iPhone 14 models following a key production cut at the virus-blighted Zhengzhou plant. Looking forward, we think exports will fall further over the coming quarters. We think that aggressive financial tightening and the drag on real incomes from high inflation will push the global economy into a recession next year, said Zichuan Huang, an economist at Capital Economics. Auto export growth in terms of volume also slowed sharply to 60% year-on-year from 106% in September, according to Reuters calculations based on customs data, reflecting a shift from demand for goods to services in the major economies. Within the recovery effect growth. Nearly 3 years into the pandemic, China has maintained strict COVID-19 containment policies that have taken a heavy economic toll and caused widespread frustration and fatigue. Weak October factory and trade numbers suggested the economy was struggling to emerge from the quagmire in the final quarter of 2022 after reporting a faster-than-expected recovery in the third quarter. The war in Ukraine, which fueled already high global inflation, added to geopolitical tensions and further dampened business activity. Chinese leaders last week pledged to prioritize economic growth and push ahead with reforms to allay fears that ideology may prevail as President Xi Jinping inaugurated a new term and disruptive lockdowns continued without a clear exit strategy in place. View was sluggish domestic demand, partially weighed down by new COVID restrictions and lockdowns in October, hurt importers. Inbound shipments declined 0.7% from a 0.3% gain in September and came in below a forecast 0.1% rise, the weakest result since August 2020. Adding to the global slowdown, weak domestic consumption will weigh more heavily on the Chinese economy for a while longer, analysts say. Insufficient domestic demand is the main constraint on China's short-term recovery and long-term growth trajectory, said Bruce Pang, chief economist at Jones Lang LaSalle.